Welcome back to a Monetary Policy Special. We have just got the minutes of the Reserve Bank's Monetary Policy Committee's meeting that ended on April 9th. And I have been speaking with the external member, Mr. Nagesh Kumar. Joining me now are two market experts. I have Abhishek Upadhyay, the senior economist at ICICI Securities PD, and Suvodeep, Rakshit, chief economist at Kotak Institutional Equities. Suvodeep, Abhishek, welcome to the show. And Mr. Nagesh Kumar, thank you very much for staying on. Abhishek, you all have read the minutes and you had the advantage of listening to Mr. Nagesh Kumar himself. What are your key takeaways? Are you getting any sense of even more dovishness than you expected? Just what the key takeaways are?
Well, the broad message is very clear. The committee clearly has a very strong conviction about the inflation outlook. At the same time, clearly compared to the last meeting, the downside risks to growth have increased, and that's why the committee downgraded the numbers also. With inflation expected to be a target and output gap, which is negative, likely to stay negative. Also, some of the worries on the external front, which were there have persisted. But what has also happened is that dollar has actually weakened. There were worries that dollar may gain when if US were to impose high tariffs, but that has not happened. Also, crude prices have come down, other commodity prices have come down. So from overall, taking all these things together, it was quite clear that a rate cut was to be done. At the same time, more importantly, the committee is also guided for future easing by changing the stance to accommodative. There is some, it appears there is some difference in views, particularly in the external members, about whether immediate rate cut, is a done deal in the June meeting. One of the external members indicates that he's voting for the current stance only because rate hikes are off the table, not because immediate easing is imminent. Another member talks about upside risk to inflation, presumably from on account of currency weakness, etc.
Yes.
Our own view is there are downside risks to both inflation and growth based on information we have currently, and therefore we pencil in at least 50 basis points or more cuts from MPC.
Okay, thanks for that. Yes, I did notice Saugata Bhattacharya saying that, giving a sense that he is not game for a cut every time. At least that's the sense one got. Suvodeep, any key takeaways that wants you to change your mind in terms of how many rate cuts and when?
So, Latha, we were at 75 to 100 bips of rate cuts even going into the policy, right? So from that perspective, we were ahead in terms of what the consensus was expecting at around 50 bips. Look, it is in some sense derived from the fact that growth is on the weaker side. And especially after the tariffs have been imposed, of course, we have seen a lot of flux after that. There is a downside in terms of the growth, and we are looking at a wide range of around 5.8 to 6.2% kind of a growth with a point estimate of around 6%. With this kind of a growth and our inflation forecast being at around 4%, the growth inflation mix, the output gap opening up, helps in our call in terms of the, let's say, 75 to 100 bips. So when we read the minutes, I think it's important to note that even Dr. Ranjan is talking about the concerns on growth now being much more than the concerns on inflation. And to that extent, the accommodative stance, as well as, if you look at the global scenario, kind of indicates that the push should be towards further rate cuts. Of course, there will be divergence of opinion in terms of whether it's consecutive or whether you wait and do the rate cuts.
Suvodeep, 1 minute. My pointed question to both you and Abhishek is the dovishness more than what the market has factored in? For instance, Suvodeep, tomorrow should we see yields lower?
Good question, because see, I think it is, for me, my read was that it is a little more dovish than what the market was expecting.
Okay, that was my reading as well. So,
yes, I think that should warrant some kind of a reaction.
Okay.
Whether now the OIS or the markets kind of look at a further 25 bips from the 50 bips of consensus, I think that we'll figure out, but I think
Fair enough.
it is deeper.
No, I agree. It will be more dovish because mentally also we have become a little more worried about global growth. Abhishek, very quickly that question. Is it more than what the market has factored in? What may the minutes do to the markets tomorrow?
Difficult for a favorable surprise, Latha, with 10-year yield already close to 6.3 levels. End of March, we were closer to 6.6. Now we are closer to 6.3. Very difficult for, these minutes to, by itself lead to, further another, sharp leg down in yields. I don't see that happening.
Okay. Well, let me toss then, get the final word from Mr. Nagesh Kumar himself. So, there are a lot of people who share the grimness of the global environment that you have very nicely explained in your minutes. The US accounts for 4 trillion of exports, which is, almost the entire Indian GDP. That's the kind of exports they consume, and they were consuming it at 2.5% tariffs. Now you take all the average 20%, 25% on automobiles and steel and aluminium, and plus add the 10% on all goods, and plus add the extra tariffs on China. Clearly, the 2.5% has gone to 25%. Now, we are looking at a very serious situation. No matter what advantage we have over Vietnam or Bangladesh, that market is now going to come at a huge price. So do you think there will be a scope for a double cut at some point? What I mean is a 50 bips in one go.
Yeah. Well, Latha, as I said earlier, these are positioning, the tariffs which have been announced. They are kind of the starting point of a negotiation or discussion. So I do not think that at the end of the day they will hold. And so there will be in negotiations between different governments, different countries and all that. So the picture would become clear in, say, 6 months down the line. And then only you will be able to decide and, that how much of a hit I am taking in terms of my growth projections and what it means for our inflation, and then accordingly craft a response. Or it is very open at this stage whether there will be a further cut, whether they will, and how many of them, and whether double or single. So I think we have to keep watching and reacting as we go along.
Okay. And is your sense on inflation that we are going to be positively surprised because so many countries will not be able to push their goods to the US and will be looking for a home? See, the Asian output gap is really large. Whatever be the global output gap, there is no doubt that Asia was the production house of the world, and now that output will look for a home. So should we bet on much more serious disinflation?
Possibility, but again, it depends on what action government of India will take to prevent this dumping from coming to Indian shores, for instance. And if it is prevented, then it is not going to be that serious.
Okay.
But if it is allowed to come to our shores, then yes, it would be affecting the prices in the economy.
That's a very fair point, sir. There are people who are complaining already that the anti-dumping on non-ferrous metals is more expensive than the imported prices, and therefore it can actually be a bit inflationary. But thank you very much for giving us a many-sided insight into what is the thinking of the Monetary Policy Committee. And thank you, Abhishek and Suvodeep, for giving me an idea of how the market may interpret. As you all point out, already a lot of dovishness is baked into the yields. At 6.3%, how much more can the yields react? That's a good question. Thank you very much for joining me on this special monetary policy issue.